A Roth retirement account is one of the best ways to save for retirement. With a Roth IRA or a Roth 401k, you don't pay any taxes on the growth of your investments, and you don't pay any taxes when you pull that money out in retirement. This helps offset one of the largest risks that you may encounter in retirement, which is the unknown of what taxes will be in the future. The challenge with Roth accounts, however, is many savers are prevented from directly contributing to them due to their income limitations. For high earners and strong savers, there's a strategy called the Backdoor Roth and a Mega Backdoor Roth that can make contributions possible. In this video, I'll walk you through what these accounts are, how to set them up, and how they can play a key role in your retirement savings strategy. Hi, I'm Greg Meyer, certified financial planner and CPA, and on this channel, I share clear and actionable strategies to help you make smarter decisions with your money. Make sure to subscribe so you don't miss future videos. There are two types of Backdoor Roth accounts: the Backdoor Roth IRA and the Mega Backdoor Roth 401k. But the concept of how they work is the same. The Backdoor Roth is a two-step process. First, you contribute to an after-tax retirement account. Since that contribution is done on an after-tax basis, there is no tax deduction. This means that you have what's called basis in that contribution. The second step is to then do a Roth conversion to move that money from the after-tax account to the Roth account. Since that original contribution was done on an after-tax basis, the subsequent conversion is tax-free. The net result is that you can get money into a Roth IRA account or a Roth 401k account without incurring additional taxes. The reason this is beneficial is because the IRS limits who can directly contribute to a Roth IRA account based on the amount of income that they make. For 2024, single taxpayers who had income over $161,000 and married taxpayers who had income over $240,000 are prevented from directly contributing to a Roth IRA account. But by utilizing the Backdoor Roth process, savers can contribute to their Roth retirement accounts without worrying about these income limitations. The Backdoor Roth IRA and Mega Backdoor Roth 401k process is similar, but there are a few key differences. Let's break down each one step by step. First, we'll start with the Backdoor Roth IRA. In 2025, you can contribute up to $7,000 to your IRA if you're under age 50, or $8,000 if you're 50 or older. You can make these IRA contributions in addition to any contributions you make to an employer 401k plan. The first step in doing a Backdoor Roth IRA is to set up your accounts. You should open two accounts: a traditional IRA account and a Roth IRA account. If you already have an existing Roth IRA account, then you can use that account. But if you have an existing traditional IRA account with pre-tax assets in it, then the Backdoor Roth IRA may not be a good choice for you. I'll go into more detail on that in just a minute. Once the accounts are set up, you can then make your annual contributions. Contributions for a given year can be made up until April 15th of the following year. So for example, 2025 contributions can be made at any point from January 2025 through April 15th, 2026. Once the contributions are made, you can then initiate the Roth conversion. A Roth conversion essentially means transferring assets from a traditional IRA account to a Roth IRA account. Typically, Roth conversions generate taxable income, but since you made the contribution to your traditional IRA on an after-tax basis, you won't owe any tax on the Roth conversion because the basis equals the fair market value of the amount you are converting. As an example, let's say you contribute $7,000 to your traditional IRA and treat it as an after-tax contribution. You then do a Roth conversion to transfer that full $7,000 from the traditional IRA to your Roth IRA. The fair market value of the Roth conversion is $7,000. Your basis in the IRA is $7,000, so the taxable income on the conversion is zero. Once the money is in the Roth IRA, it can then be invested for future tax-free growth and withdrawals. Now let's talk about the Mega Backdoor Roth. As I mentioned before, the concept of the Backdoor Roth and the Mega Backdoor Roth is similar. The key difference between the two are: one, the amount of contributions that you could do in a given year, and two, the limitations that you have if you have an existing pre-tax IRA account. A Mega Backdoor Roth is done through an eligible employer 401k plan. 401k plans have much higher contribution limits than IRAs, so a Mega Backdoor Roth gives you a greater ability to maximize your retirement savings. In 2025, you can contribute up to $23,500 to your 401k if you're under age 50, or $31,000 if you're 50 or older. These contributions are known as the employee deferral amounts, and you can choose to make these contributions on a traditional or Roth basis. But 401ks allow you to save even more than this because they have an annual contribution limit of $70,000 in 2025. The contribution limit is comprised of the employee contribution, the employer match, and after-tax contributions. As an example, let's say you participate in your employer 401k plan and max out your pre-tax contributions of $23,500. Your employer has a generous 50% match, so they make a matching contribution of $11,750. This brings total pre-tax plus employer matching contributions to $35,250. With a $70,000 annual contribution limit, that means you have the ability to make an after-tax contribution of up to $34,750. This after-tax contribution of $34,750 is the amount that can be converted to a Roth 401k tax-free. As I mentioned a few minutes ago, the ability to do a backdoor Roth IRA can be limited if you have existing assets in a pre-tax IRA. The reason for this is because you need to take into account all of your traditional IRA accounts when calculating how much of the Roth conversion is taxable. So if you have existing pre-tax money in an IRA, when you do the Roth conversion, some of the conversion will be treated as a conversion of pre-tax assets, which is taxable, and some of the conversion will be treated as a conversion of after-tax assets, which is tax-free. On the other hand, the Mega Backdoor Roth through your 401k does not have this limitation. As long as your 401k plan allows after-tax contributions and in-plan Roth conversions, then you have the ability to make both pre-tax contributions up to $23,500 and after-tax contributions, which can then get converted into a tax-free Roth account. The Mega Backdoor Roth through the 401k plan offers much more flexibility. So who should use these strategies? The Backdoor Roth and Mega Backdoor Roth isn't for everyone. If you need to prioritize take-home cash flow to cover bills, build up your emergency fund, or save for short-term priorities, it may not be the best choice for you right now. But if you do have the cash flow, then it can be a fantastic way to maximize retirement savings and save for the future. Some people who may want to consider adding this to their saving strategy are high earners who are already maxing out their traditional 401k contributions. People who have cash flow left over after funding their emergency fund, paying off debt, and covering other financial goals, and they want to prioritize long-term savings. Those of you who expect to be in similar or higher tax brackets in retirement, or those who expect tax rates to increase in the future. And lastly, if you're self-employed, setting up a solo 401k can make this even more beneficial. Many solo 401k plans allow after-tax contributions and in-plan Roth conversions, making the Mega Backdoor Roth a great option for entrepreneurs and small business owners. This strategy is especially powerful for people in their 40s and 50s who may be in their peak earning years and want to supercharge their Roth retirement savings. The Backdoor Roth and Mega Backdoor Roth can even be done in conjunction with one another, giving you the ability to save up to $77,000 in tax-favored accounts each year. Of course, there are some important considerations and pitfalls to watch out for. The first is plan limitations. Not every 401k plan allows after-tax contributions or in-plan Roth conversions. You'll need to check your plan documents or talk to HR to see if your plan is eligible. The second is timely conversions. If you leave money in an after-tax account too long before converting it, then those earnings will become taxable. The key is to convert promptly from the after-tax account to the Roth account, so all growth occurs in the Roth tax-free account. Third is cash flow needs. You will need significant disposable income to make this strategy work. Don't shortchange your emergency fund or other priorities. And lastly, tax reporting. Backdoor Roth IRA conversions need to be reported on Form 8606 when filing your tax return. You want to make sure that your tax preparer understands that this is a backdoor Roth conversion and that you have basis in your IRA being converted. I've seen this mistake many times, and it results in the taxpayer paying tax twice on the amount being converted. The Backdoor Roth and Mega Backdoor Roth is a strategy that allows you to put tens of thousands of extra dollars into a Roth account that can then grow tax-free. It's a game changer for strong savers, especially high earners in their 40s and 50s, but it's not right for everyone. The bottom line, check your plan documents, run the numbers, and if it fits your situation, this could be one of the most powerful retirement moves that you can make. If you found this video helpful, please make sure to subscribe for future financial planning and tax strategy videos.